$64.8 billion did not simply vanish into the ether. It never existed in the first place. For decades, the global financial elite entrusted their fortunes to a single, unimpeachable figure on Wall Street, seduced by the promise of impossibly steady returns in an inherently volatile market. This was not a sophisticated algorithmic trading anomaly or a sudden market crash. It was a mirage constructed entirely of paper and prestige. The architect of this devastation sat on the advisory committees of regulatory bodies, fundamentally shaping the modern stock market while simultaneously operating a financial black hole from the 17th floor of the Lipstick Building in Manhattan. At its core, the operation was a Ponzi scheme, a form of financial fraud that lures investors and pays profits to earlier backers with funds from more recent investors rather than from legitimate profit. The structure requires a constant, accelerating flow of new capital to survive, collapsing the moment redemptions exceed incoming cash. Yet Bernie Madoff elevated this crude, century-old grift into an art form of unprecedented scale and sophistication. He did not target the desperate or the financially illiterate. He targeted the apex predators of global finance, hedge funds, international banks, and aristocratic dynasties who believed their immense wealth shielded them from common deception. To understand the anatomy of this historic deception, one must examine the impenetrable armor of legitimacy Madoff wore. He was not an outsider peddling get-rich-quick fantasies from the fringes of the financial sector. He was a pioneer of electronic trading who helped launch the NASDAQ stock market, eventually serving as its non-executive chairman. His legitimate market-making business executed a massive percentage of daily trading volume on the New York Stock Exchange. This pristine, highly regulated front operation provided a blinding halo of credibility. When institutional investors looked at his firm, they saw a foundational pillar of the financial establishment, a perception that effectively short-circuited standard institutional skepticism. The bait used to capture billions was an investment strategy Madoff called the split strike conversion. He claimed to buy a basket of blue-chip stocks while simultaneously purchasing put options to limit downside risk and selling call options to generate income. On paper, it was a perfectly sound, conservative strategy designed to yield steady, single-digit returns regardless of broader market turbulence. The returns were never spectacularly high, which was precisely the genius of the lie. A promised return of 10 to 12% year after year with virtually no volatility was the financial equivalent of a perpetual motion machine. But the mathematics of the split strike conversion were merely the intellectual cover story. The true engine of the fraud was deeply psychological. Madoff weaponized exclusivity. He did not advertise his advisory business. He routinely turned away millions of dollars, claiming his funds were closed to new capital or that the prospective client simply did not fit his profile. This manufactured scarcity triggered a primal fear of missing out among the ultra-wealthy. Getting an audience with him became a coveted status symbol in the affluent enclaves of Palm Beach and the elite country clubs of Long Island. He relied heavily on affinity fraud, exploiting the inherent trust within tight-knit charitable and religious communities to bypass standard due diligence. Despite this psychological mastery, the numbers themselves remained an inescapable vulnerability. In 1999, a quantitative analyst named Harry Markopolos was tasked by his employer to reverse engineer Madoff's strategy in order to replicate his legendary returns. Within 5 minutes of examining the revenue streams, Markopolos knew the returns were mathematically impossible. Within 4 hours, he concluded that the operation was either illegally front-running the market or functioning as a massive Ponzi scheme. The options trading volume required to execute the stated strategy far exceeded the total number of options actually in existence on the Chicago Board Options Exchange. What followed was a masterclass in systemic regulatory failures. Markopolos submitted multiple detailed dossiers to the SEC, explicitly outlining the mathematical impossibilities of the returns. In his 2005 submission, bluntly titled "The World's Largest Hedge Fund is a Fraud," he provided a 29-page roadmap for investigators, begging them to simply verify the trade tickets. The SEC possessed the ultimate authority to demand clearinghouse records, which would have instantly proven that no trades were actually taking place. Yet, the agency's enforcement division, chronically underfunded, compartmentalized, and staffed by lawyers lacking deep quantitative expertise, repeatedly fumbled the inquiry. This institutional blindness extended far beyond government regulators. Feeder funds, massive financial entities whose sole operational purpose was to funnel client money into Madoff's operation, willfully ignored glaring red flags. They collected hundreds of millions of dollars in management fees for conducting supposed due diligence, yet they accepted dot matrix printed account statements generated by a mysterious, antiquated computer system. The auditing of this multi-billion-dollar enterprise was ostensibly handled by a strip mall accounting firm with only 3 employees, one of whom was an 80-year-old retiree living in Florida. The entire financial ecosystem, enriched by the steady flow of capital, incentivized looking the other way. Inside the 17th floor of the Lipstick Building, physically locked away from the legitimate trading floor, the mechanics of deception were painstakingly manual and absurdly primitive. A small, fiercely loyal staff, lacking formal financial education, spent their days retroactively fabricating trade records. When the broader market went down, they would look at historical newspaper stock tables, pick trades that would have been profitable, and type them into the client's statements. There was no actual trading. The billions of dollars wired into the firm were simply deposited into a single Chase Manhattan bank account. When clients requested withdrawals, the money was wired out of that exact same account. This delicate equilibrium of incoming capital and outgoing redemptions could have theoretically persisted for another decade had it not been for a macroeconomic earthquake. The 2008 financial crisis triggered a catastrophic liquidity crunch across global markets. Institutional investors, desperate for cash to cover margin calls and staggering losses elsewhere, turned to their one supposedly safe asset. In the final months of 2008, redemption requests surged to an unprecedented $7 billion. The Chase Manhattan account, the sole reservoir of the entire empire, held less than $300 million. The illusion shattered with breathtaking speed. In early December 2008, cornered by the undeniable mathematical reality of his depleted reserves, the architect confessed to his sons that the entire asset management arm was, in his words, one big lie. His sons, who served as executives in the legitimate market-making side of the business, immediately alerted federal authorities. The arrest was swift, but the realization of the devastation was agonizingly slow. The final account statements mailed to clients showed a collective balance of $64.8 billion. The actual recovered cash was a fraction of a percent of that phantom wealth. The human cost of this investor fraud was immediate and catastrophic, extending far beyond the balance sheets of elite hedge funds. Philanthropic charities were decimated overnight, major universities lost massive portions of their endowments, and thousands of retirees were instantly plunged into destitution. The devastation drove multiple victims to suicide, including a prominent French aristocrat who had funneled his clients' money into the fund, and tragically, the perpetrator's own son. The psychological trauma of realizing that lifelong savings were vaporized by a trusted confidant left deep, unhealable scars on communities across the globe. In the aftermath, the monumental task of unwinding the wreckage fell to forensic accounting, the specialized practice of investigating financial discrepancies to trace hidden, altered, or missing funds for legal proceedings. The court-appointed trustee initiated a relentless, decades-long campaign of clawback lawsuits. These aggressive legal actions targeted the feeder funds, the complicit international banks, and even early investors who had unwittingly withdrawn more money than they initially deposited. The objective was to pool all recovered assets and distribute them equitably among the victims who had lost their principal investments, stripping away the illusion of fictitious profits. The legacy of this historic fraud forced a profound reckoning within global financial markets and regulatory bodies. The SEC underwent a massive internal overhaul, implementing new risk-based data analytics to detect anomalous trading patterns and establishing a dedicated, highly funded whistleblower office. The era of accepting paper statements without third-party electronic verification effectively ended. Yet the quiet settlements behind closed doors and the ongoing fines levied against major banks hinted at deeper systemic vulnerabilities that regulations alone could not entirely erase. The anatomy of this deception reveals a chilling truth about the architecture of modern wealth. The greatest financial crimes do not require complex, impenetrable algorithms or shadowy offshore networks to succeed. They require a compelling narrative, an unimpeachable facade, and a willing audience eager to believe in the impossible. The billions lost were not stolen in the dark of night. They were handed over in broad daylight, accompanied by handshakes, country club pleasantries, and a collective willful blindness that ultimately brought Wall Street to its knees.